This three-digit number controls whether you can buy a house, rent an apartment, get a car loan, or even get certain jobs. It affects the interest rates you pay on everything. And here's the crazy part. Most people have no idea how it actually works. I'm talking about your credit score, and today I'm going to break down exactly what it is, how it's calculated, and most importantly, how you can start building yours, even if you're starting from zero. Let's map it out. So what exactly is a credit score? In simple terms, a credit score is a three-digit number, typically ranging from 300 to 850, that represents how trustworthy you are when it comes to borrowing money and paying it back. Think of it like a grade for your financial behavior. Lenders, landlords, and even some employers look at this number to decide if they want to do business with you. The most common scoring model is called FICO, and it's used by 90% of lenders when making decisions. So when someone talks about credit scores, they're usually talking about your FICO score. Now here's something interesting. The average FICO score in the United States, as of 2025, is 715. That falls right in the good credit range. But what do these ranges actually mean? Let me show you. Credit scores are divided into five main categories. Let's break them down from worst to best. 300 to 579. This is considered poor credit. If you're in this range, you'll have trouble getting approved for most loans and credit cards. If you do get approved, expect very high interest rates. 580 to 6069. This is fair credit, sometimes called subprime. Lenders see you as higher risk. You can get approved for some products, but not the best ones. 670 to 739. Now we're in good credit territory. This is where most lenders start to feel comfortable. You'll qualify for most credit products at decent rates. 740 to 799. Very good credit. You're in a great position here. You'll get approved easily and qualify for better interest rates. And finally, 800 to 850. Exceptional credit. This is the top tier. You get the best rates, the best terms, and instant approvals. Less than 25% of Americans have scores in this range. Here's the key takeaway. You don't need a perfect 850. Once you hit about 760, you typically qualify for the best rates on everything. Anything above that is just bragging rights. Now here's what you really came for. How is your credit score actually calculated? Your FICO score is based on 5 factors, and understanding these is the key to improving your score. Factor number 1, payment history. This makes up 35% of your score. It's the single most important factor. This looks at whether you pay your bills on time. Every on-time payment helps. Every late payment hurts, and a payment that's 30 or more days late can stay on your credit report for 7 years. The takeaway here is simple. Pay every bill on time every month. Set up autopay if you need to. Factor number 2, amounts owed, 30% of your score. This is mainly about something called credit utilization, the percentage of your available credit that you're actually using. Here's the formula. Take your credit card balance and divide it by your credit limit. If you have a $1,000 limit and a $300 balance, your utilization is 30%. Experts say to keep this under 30%, but people with the highest scores typically stay under 10%. So on that $1,000 limit, try to keep your balance under $100. Factor number 3, length of credit history, 15% of your score. This looks at how long you've been using credit. The longer your history, the better. This is one reason why you might want to keep old credit cards open, even if you don't use them much. Factor number 4, new credit, 10% of your score. Every time you apply for credit, the lender checks your report. This is called a hard inquiry, and it temporarily lowers your score by a few points. Too many applications in a short period looks risky to lenders, so don't go crazy applying for every credit card you see. And finally, factor number 5, credit mix, 10% of your score. This looks at the variety of credit you have: credit cards, car loans, mortgages, student loans. Having a mix shows you can handle different types of credit responsibly, but don't open accounts you don't need just to improve your mix. This factor is the least important. So to recap, payment history and amounts owed make up 65% of your score. Focus there first. Now let's bust some credit myths because there's a lot of bad information out there. Myth number 1. Checking your own credit score lowers it. This is completely false. Checking your own score is called a soft inquiry, and it has zero impact. In fact, you should check your credit regularly. It helps you catch errors and track your progress. Myth number 2. Carrying a balance on your credit card builds credit faster. Nope. You do not need to carry a balance. Pay your card off in full every month. All that matters is that you have activity on the card and pay on time. Carrying a balance just costs you money and interest. Myth number 3. You need a perfect 850 score. A perfect score is nice for bragging, but it's not necessary. Once you hit about 760, you qualify for the best interest rates on everything. There's no special 850 club with extra benefits. Myth number 4. Your income affects your credit score. Your income is not on your credit report. Someone making $40,000 can have a higher score than someone making $200,000. It's all about how you manage what you have, not how much you make. And myth number 5. Bad credit lasts forever. Not true. Most negative information drops off your credit report after 7 years. Your score is a snapshot in time. It can absolutely recover. So what if you're just starting out and have no credit history at all? Here are 4 ways to build credit from scratch. Method 1. Get a secured credit card. A secured card requires a cash deposit, usually around $200 to $500. That becomes your credit limit. So you deposit $500 and you get a $500 credit limit. Use it for small purchases, pay it off every month, and after about 6 to 12 months of positive history, you can typically upgrade to a regular unsecured card and get your deposit back. Method 2. Become an authorized user. If you have a parent, partner, or trusted friend with good credit, ask them to add you as an authorized user on their credit card. Their positive payment history on that account can help build your credit. You don't even need to use the card. Just being on the account helps. Method 3. Try a credit builder loan. This is a loan in reverse. You make payments first, and the bank holds the money. At the end of the loan term, you get the money back. It's specifically designed to help people build credit. Some banks and credit unions offer these with terms from 6 to 24 months. Method 4. Use Experian Boost. This is a free service from Experian that adds your utility bills, phone bills, and even streaming service payments to your credit file. 60% of people who use it see their score increase, with an average boost of about 12 points. It's quick and easy to set up. All right, let's wrap this up with your action plan. 3 things you can do right now. Number 1. Check your credit score for free. Use Credit Karma, the Experian app, or annualcreditreport.com. Know where you stand. Number 2. Set up autopay on everything. Payment history is 35% of your score. Don't leave it to chance. Automate it. Number 3. If you don't have any credit accounts, apply for a secured credit card. Look for one with no annual fee that reports to all 3 credit bureaus. Building credit takes time, usually 6 months to a year to see real progress. But the sooner you start, the better your financial future will be. And that's Credit Scores Explained. You now know more than most people about how this number works and what you can do to improve it. If this video helped you, hit that subscribe button. I put out new videos every week breaking down personal finance concepts just like this one, all visualized so they actually make sense. Next up, I'd recommend checking out my video on the 50-30-20 budget rule. It's the perfect next step after building your credit foundation. Thanks for watching, and I'll see you in the next one.